Hey everyone, welcome to Monthly Market Insights. We'll get started here in a minute. We are now live on Facebook. All right, see my screen?
Yes.
Perfect. Let's get going.
All right. Hi, everybody. Welcome to the Monthly Market Insight for September. We typically hold these on the first Monday of every month, but obviously yesterday was Labor Day. So we hope everyone had a good kind of end of summer celebration, a wonderful Labor Day weekend. So as we get into it, Sean, walk us through kind of year-to-date performance. I know there's a lot of information out there. So can you help us make sense, or investors make sense of all the data out there? Unemployment numbers, the jobs report came out last week. What does that mean for, the Fed's rhetoric around their position on, interest rates, and then ultimately what's going on with inflation? We've had kind of wrapping up our third quarterly meetings with clients, and we have a lot of people saying, you say inflation's going down, but I ultimately don't see it, right? I don't feel it. So can you kind of explain a little bit about that as well?
Yeah, absolutely. So we got the jobs report last Friday, and what it showed is unemployment ticked up slightly to 3.8%, but really unemployment stayed between about that 3.4 to 3.8% now for about the last 18 months. And so that's what the Fed is watching most closely, right? We kept hearing about this talk about recession last year and what may happen. And ultimately what we're seeing is that the Fed is watching unemployment before they're going to go ahead and lower interest rates. So if anyone's waiting to buy a house or buy a car or borrow money for whatever reason, the Fed has come out really throughout July. They had their big Fed meeting up in Jackson Hole, Wyoming. They said, don't plan on us lowering interest rates here in the year 2023. In fact, the plan is to do one more interest rate hike here in 2023. So if anyone's kind of waiting on the mortgages to get back to 2.75 or 3.25, we don't see that happening really anytime soon. Now, the good news is inflation has come down. So it peaked last year in 2022 in June at about 9.1%. And it's steadily come down over the last 16 months now. And now it's floating at 3.2%. So that was the number that came out last month in August. So we'll get next week's number, next month's number next week, I should say, and we'll kind of see how inflation is doing. Now, that's exactly right, Nora. People say, I keep going to the grocery store and I hate checking out still. So I don't see that inflation is coming down. But we have to remember that 3.2% is based on the previous 12 months. So that's not going back to kind of pre-COVID numbers, pre-2020, where inflation started to get out of control. It really is going back to the last 12 months. So that includes the 9.1% we saw in 2022. It's still going up, but it's not going up at such a rate that it's kind of still uncontrollable. So we're not going to go back to kind of those old prices necessarily. We're not going to get deflation to go back to the old prices that I wish we would see back in the grocery store, but we're still getting kind of a much slower growth. Now, the Fed's target is 2%. And so they don't have any appetite to lower interest rates until inflation kind of calms down to that 2% rate, again, kind of from the previous 12 months. So kind of the fear is that long term, if they were to lower rates right now, and I'll use the housing market as an example, is that we flood the market with more buyers, but we haven't increased our inventory. So now we just get right back into this inflationary time period where people's home values go up because people are outbidding, even though that's still happening across the country. And all of a sudden, people's home values go up. They start sucking out that equity, spending money. We get right back into inflation, that 9% range, or kind of above 5%. So the good news is a lot of those things have come down. We're seeing new home builders build again because a lot of those commodity prices have come down. The lumber, the copper, the grain, kind of those commodity prices have come down quite a bit, energy, and therefore we're not seeing as rapid of a change in inflation, but it's still high at 3.2%. So that's some of the questions we get from clients is like, I'm just not feeling this, hey, inflation's calmed down. We can't reset our mind to kind of previously to pre-COVID and pre-2022 for sure. So inflation is still happening, but it's at a much more controllable rate. And that's why the market's been doing much better. Okay, so in 2022, we saw inflation up around 9.1%. We saw the S&P 500 lose about 19% in 2022. We saw the bond market also lose 13% in 2022. And that was because the Fed was rapidly raising interest rates. So those things are kind of inversely correlated. Rising interest rates means falling bond prices. So we saw that happening. But the market, as you can see by the chart here in 2023, has done much better. And we'll kind of go into a little bit of detail of what we're seeing in there. But that's because the market's starting to understand, okay, we do seem to have inflation under control, or at least it's trending in the right direction of it being under control. We have much better outlook on what the Fed's mentality is. They're communicating, saying, hey, don't anticipate these things. So the market doesn't like uncertainty. It doesn't like, hey, is inflation going to continue? It doesn't like, what's the Fed going to do with interest rates? But as soon as the market knows or believes it knows what's going to happen, it can start to make kind of adjustments in terms of overall pricing. So what we'll see in here is a couple of the positions we have in our portfolio, and we'll kind of look at how they're doing here in 2023. So that QQQ, that's going to kind of be the NASDAQ, right? So a lot of our technology, our growth-based companies, you can see that has been the best performer year to date, up over 42% year to date. And what that is really telling a bigger story of is what's happening in the overall economy. So we see that blue line, the QQQ, up about 42%. We see the red line, the VOO, that's the S&P 500 index. That's up about 18%. Now, the key driver in all that is there are a few companies that make up the majority of the S&P 500 when we look at from a market cap index. And I'll go into that here in a little bit. But the S&P is being pulled up by a lot of those growth, those technology-based companies. The rest of the market is still having a good year, but not nearly as good of a year as kind of the top 10 holdings. And when you think about some of those companies, that's the NVIDIAs, right? The people making processing chips. We've got Apple and Google and Meta and Microsoft. Kind of the largest tech-based companies are having a phenomenal year. And some of that may be some of this artificial intelligence. People still aren't sure, is this going to be the next cell phone? Is this going to be the next internet? Is this that new innovation that's going to change the game? And therefore, some of those growth-based companies are going to have much better earnings in the future. And so we're seeing that in the market. If we look at the RSP, this purple, this is also the S&P 500, but it doesn't kind of overweight the positions that make up a higher market cap. So in this example, if I had $500 invested in the S&P 500, which is essentially the Fortune 500 companies in America, I would give each company $1. So they're all equally weighted in the S&P 500. If we do that, the S&P is drastically, right, underperforming what the current S&P 500 is doing. So those tech-based companies are kind of pulling up the bottom 490, right? The bottom 490 companies in the S&P. So technology has really been the biggest growth factor inside of 2023 here. And kind of everyone else is just kind of having a normal ho-hum year, if you will. And that's why you kind of see an equal weighting market cap drastically underperforming a market cap S&P 500. And again, technology, NASDAQ really outperforming all of those. Then we have the bond index, right? So bonds are there to be stable. We see that is still down for the year. And the reason is because the Fed continues to raise interest rates. So if I owned a Coca-Cola bond that was paying me 3%, that made sense when the Federal Reserve had the interest rate around 0.25, like it did really from 2008 almost all the way up through 2022. Now that the Federal Reserve has raised the rate so quickly and now it's floating around 5.25%, if I had that 3% Coca-Cola bond, I would sell it. So it drives down all those prices. And now Coca-Cola, if they want to raise money via bond, they've got to offer 5, 6, 7%. So the newer bonds are coming online because interest rates continue to rise. So bond prices should go up if and when the Fed lowers interest rates. The question is, when does that happen? And so far, the Fed has said, don't expect it in 2023. So a lot of our advice to clients has been, hey, if you're going to borrow money, maybe use some of your own money in your brokerage accounts or your savings account rather than going out and borrowing money at 10, 12% in some cases, depending on how you're doing it. Mortgages are up over 7%. So borrowing money becomes less attractive, which is what the Fed is trying to do by raising interest rates to cool off inflation. So that story continues. So when will the Fed lower interest rates? They're looking at the unemployment number, right? And if that gets above 4, really above 4.2, around 4.5, then the Fed would have a much larger appetite to say, okay, I've caused too much pain on the economy and I should start to lower interest rates. So until that number starts to change, I wouldn't expect interest rates to go down until we see unemployment tick up. So that's kind of been the overall market throughout 2023 and kind of a recap of how 2023 is going. And just to highlight kind of the size of some of those companies, if we look at the Apples, the Microsofts, Amazons, the NVIDIAs, the Googles, the Teslas, Berkshire, United Healthcare, right? What we'll see is they make up about 30% of the overall S&P 500. So when those companies do really well, NVIDIA is up over 200% for the year, then it kind of pulls up the bottom of the rest of the economy. And that's why the S&P in general is up over 18% for the year, because those largest corporations are doing so well this year. So we want kind of the bottom 490 to start plugging along and then start to kind of have earnings and expectations that kind of outpace what the market expects them to do. And that's when they kind of really kind of take off. But the good news is inflation's coming down, unemployment remains stable. Therefore, the economy should continue ticking along, right? Should all things stay constant. Another thing we want to kind of point out, so if we go back to before 2007, before kind of the housing market crash, all those things, what we always want to do is help people be long-term investors, right? Build a diversified portfolio that they can trust and continue to stay invested. And so we look at those exact same holdings. What you'll notice is the NASDAQ has still done really, really well, right? The kind of the highest growth companies. The S&P is still done extremely well. And I know that's hard to imagine right now because we still have some of the pain in the market from 2022. But in here, we had the 2008 housing market crash. We've got the 2018 Trump-China trade war and the Fed trying to raise interest rates at a time that maybe they shouldn't have. The market lost 20% there. And then we've got 2022 coronavirus. We also have the 2022 pullback. So our last market high was December 31st of 2021. That's an incorrect date there. So 2021 was the last market high. So we can see everything looks really great there. If we fast forward and go all the way from that same time point through 2023, we see the pain of 2022 kick in, but the markets are still very, very positive. And one thing I've said is every time there's been a market high, there's always been another market high. Now, certainly past performance is not indicative of future results, but we want to stay invested for the long term because in 2008, it was hard to stay invested. In 2018, it was hard to stay invested. 2020, same thing. 2022, it is the same thing, but the market will come back. We just don't want to get into, is it going to happen this year, next year? We don't know when that time will be. So we want to build a diversified portfolio so we can stay invested those times, because ultimately everyone would like to stay invested and be up here or up here, but it's hard to kind of get through that time period. The other thing I want to point back is the bonds, right? Really suffered a huge pullback last year. Catastrophic, right? The biggest pullback in the bond market really ever in the history of the markets. And that's just because the Fed was raising rates so fast. But if I buy a bond and I hold it to its maturity, I'm going to get the interest rate that I signed up for. Meaning if I signed up for that Coca-Cola 3% bond that I used earlier, if I hold it till its maturity, I'm going to get 3%. It's just the price of that bond drops as the Federal Reserve raises interest rates, because if I wanted to go sell that Coca-Cola bond at 3%, no one's going to want to buy it because now there's a much higher coupon that I can go out and buy. So that's really been the story of the markets, how interest rates have impacted the markets, what the Fed is looking at. Again, it's going to be that unemployment data, which usually comes out around the first of the month. And then we can kind of use that as a barometer for what we think the Fed's going to do moving forward. So we'll get in the inflation report next week. We'll get the next unemployment number in early October, and that will continue to inform the markets about what we think is going to happen overall. But again, the best strategy is going to be build a diversified portfolio, stay invested long-term. We're not quite at our market high of the S&P 500 from December 31st of 2021. But if we stay invested, at some point we'll get there. And that's kind of our message to our clients.
Thanks, Sean. Appreciate it. One of the things I kind of want to touch base on, which has been a lot, been brought up a lot in some of our conversations with clients in our quarterly meetings is, let's say if you're somebody that knows you have an expense coming in 6 months, 12 months, what would be a good strategy for them, considering some of the information that's coming out, what banks are doing and things like that? Yeah, absolutely. So we've gotten a lot of these lately, and it's, hey, I've got a bank offering me 5% or 4.75% to put money in a high yield savings account. I'm being offered, 5.25% through a CD, right? There's lots of new ways that banks are able to generate revenue. And we think that could be a really good strategy.
But you have to understand what you're signing up for, right? So if I sign up for a bank savings account, the good news is I'm going to get money that's, should be FDIC and SIPC insured through the bank. And so I'll have that money here. It's safe and it's very liquid. So if I ever need to pull money out, I know I'm going to get that. But it's also very, very influenced by the change in the interest rate throughout the Fed. So if the Fed starts to lower interest rates, it doesn't mean that you're going to get that 4.75 or 5% forever. The bank's going to move that interest rate based on what's happening in the overall economy. So if you're looking to park some money for a very short time period, that can be a great place to put money. And good for the banks, right? They're using it as a way to capitalize on new business. What we've seen is a lot of time the banks are saying, hey, if you sign up for monthly deposits into our account from your payroll, then we'll give you this interest rate. If it's new money that comes into the bank, then we'll give you that interest rate. If you've been with that bank for 10 years, we've seen them say, yeah, that one's not really for you, right? It's kind of like the old new cell phone or whatever it may be, right? Here's a deal for kind of new customers or new money that can come in. So just be aware of that. Nothing wrong with doing something like that. Do your research on the bank. Try and find out, have they been around a while? Are they tied up in that SVB or First Republic Bank, right? What can I make sure that my money is going to be safe in that institution? So it can be a really good place. The other thing that we've talked about is CDs. So CDs can be a really good investment for something where I know the time period, because if I invest in that CD, I'm signing up for a contract. That is, if I give that bank that money, they'll put my money in a certificate of deposit, and it may be for 1 year. It can be for really any time period, any given number of months, 1 year, 2 year, 3 years. So that can be a good place if I say, I know I just want some safe money. I'll go get 5% of this money, and I know I'm not going to need it, right, in the next 6 months. Because if all of a sudden I need to go access that money in 6 months, but I signed up for a 2-year CD, well, I'm going to be subjected to, again, interest rate risk. So if the Fed continues to raise interest rates, I'm going to have to sell the CD that may not be as attractive because the new CDs out there are offering a higher interest rate. So you may have to sell that CD at a discount and actually lose some money on it, right? So just be very careful and understand what you're signing up for. But using CDs or money markets can be a great way to save with a guaranteed rate, or I shouldn't say guaranteed, a much higher fidelity of that money still being there in the long term. And that way you can know it's safe and know it's fixed for a certain time period. We still are a fan of a conservative brokerage account for kind of that money that I don't have a plan for. I just want it to be invested safely, and there is no specific time period for this. I just want it to be hands off. So you could just build out a conservative brokerage account mixed of stocks and bonds that would be more heavily weighted in bonds. So lots of different strategies with money, something that's changed really in the last 15 years. Since 2008, when the Federal Reserve rate lowered the interest rate down to 0.25%, banks just haven't had a whole lot of opportunity to say, hey, put your money in our savings account. I'll pay you 0.2% or 0.3%. It just didn't make a whole lot of money to put money in savings. Now it's a kind of much more attractive place for people to park safe money that they know that they're going to need in the next couple of years or a fixed time period. Those can be great avenues to kind of have some safe money sitting around.
Great. Thanks, Sean. I appreciate that. So that kind of wraps up our monthly market insight for September. As we get more information, which will provide more detail and kind of a roadmap moving forward through the end of the year, please reach out to us if you have questions. If not, we will see you in October.
Thanks, everyone.